Okay, I'd like to call to order the February 25th Joint Retirement Investment Board meeting. The agenda this evening will start with approval of the minutes, which I was not here for, so I'll have to abstain. And then we have the Milliman presentation. We have some performance updates from BlackRock, and we can continue talking about the SAA. Maybe we'll put that to bed. And then we'll have old business, new business, et cetera. Does anybody want to?
I'll make a motion
Yes.
to hear and discuss the approval of minutes.
Thank you. Second?
Second the motion, Eric
Okay,
Caliper.
Mr. Caliper? Any discussion or questions, revisions, updates, comments on the minutes?
There was if I could interject from the field here.
Mm-hmm.
There's a typo in the minutes. I don't know if, Calvin, I sent the correction to you. I don't know if you caught it or not.
I got that one, thank you, Tom.
Okay, great.
Okay. So you already have that taken care of?
Yeah, it's no typo. Yeah.
Good. Anybody else on the minutes?
I don't have any comments.
Okay, great. They're always good. Calvin does a good job. All in favor of accepting the minutes?
Aye.
Aye.
Okay, any noes? I'll abstain because I wasn't here. 2 abstentions. They pass.
Great.
Okay. Is Milliman here and ready? Oh, there she is. Hey, Jen, how are you? How you doing?
Good, how are you all?
Terrific. Okay, I'm going to throw the floor to you.
Okay. I will share my screen here.
Yeah, just let us know what document you're on and pages.
So the first one I have to go over is the town pension. So the Town of Fairfield Employees Retirement System highlights. It's a 10-page packet there.
You have ready just a second.
I think that file name is the
Yeah.
FFT
FFT.
FFT, yeah.
2025 pension
Yeah,
evaluation.
yep, 10 pages. Okay, is everybody good with that? Joe, you got it? Okay, terrific. Go ahead, Jen.
All right, so I'm here to present the results of the July 1st, 2025 valuations. On the pension plan, these are full valuation. On the pension plans, these are full valuations, so it reflects both updated census information as well as updated asset information. For the OPEB, you'll recall that we only do valuations in the even years, full valuations in the even years. So in the odd years, we do an off-year calculation that reflects updated asset information, but only a projection of the liability, assuming no gains or losses. So first, we're going to go over the town pension plan. And, all in all, a pretty good year. The assets returned about 9% during the fiscal year ending June 30th, 2025. There was a slight improvement in the funded ratio from 83% to almost 85%. If you'll recall, last year I had performed an experience study of the pension plan assumptions and came back with a variety of recommended assumption changes, and the JRIB voted to phase in those changes over a 2-year period. So we're in the second year of that phase in. So that as a result, that caused the liability to increase by about $1.1 million. Other than what it would have otherwise done, or about 0.4%. We're also coming through to this year with another update to the mortality table. This is a very minor update. A few years ago, we reflected a mortality assumption to the Pub 2010 mortality tables. The Society of Actuaries has come out with a new table. They've committed to doing this every 5 to 6 years or so. So we are at that point now. This assumption had a very minor impact, so not as big of an impact as it was several years ago, and it actually lowered the liability slightly. I'll get into those details in just a bit. So moving on to page 1, we'll look at the membership of the plan, both as of the valuation date and historically. On the top left-hand corner of the page, you can see the membership over the last 5 years. Broken down to 3 main categories. The first being what we call terminated members. That's the top section there. Those reflect members who have stopped working for the town, but they have not yet started to collect a benefit. There are 104 of those as of the valuation date. About half of them have a vested benefit, meaning they're entitled to a monthly benefit in the future, and the other half they only have a refund of their member contributions due to them. So they didn't work for the town long enough to become vested. They just have a refund of those contributions due to them. The second category is your members and pay status. That is the middle section there. That count has gone up to 523 as the valuation date. This category reflects the members who are currently receiving a benefit from a monthly pension benefit from the plan as of the valuation date. And the last group are your active members, and these are the people that are currently working for the town. They're still working for the town, and they're in the pension plan. As you know, the town pension plan has been closed for several years to new hires. It's actually open only to one small group, and that is the fire mechanics, and there are only 2 of them in the plan. So as a result of that, we expect the active membership to continue to decline over time. And as you can see, it's done that over the last 5 years. We're down to 260 members this year. Looking to the bottom left-hand portion of the page, we've graphed the distribution of the active membership based on age and years of service. You'll notice right here, these are the 2 fire mechanics that have less than 4 years of service. But a majority of the population is concentrated in higher years of service and higher age, and that is due to the closed nature of the plan. We expect to continue to see this darker shade to shift further and further to the bottom right-hand quadrant of this graph. All right, any questions on the membership before I move on? Okay, so moving on to the assets. As I mentioned earlier, the assets return about 9% for the year. We expected investment income of about $16 million during the year. Actual investment income was just over $21 million. So that was a $5 million asset gain. So the assets outperformed our expectation by $5 million. Looking to the top left-hand portion of the page, you can see the returns over the last 5 years. Now, if you recall, for purposes of calculating the contribution, we use what is known as an actuarial value of assets. And so with that, we smooth in investment gains and losses over a 5-year period. So this large gain from fiscal year 21 has now been fully recognized in the actuarial value of assets. We're in year 5 of that. The loss from 22 has 1 year left. So 1 more year, and that will be in the rear view mirror as far as the funding of the plan is concerned. And then we've had 3 good years of returns outperforming the expectation. Overall, there are deferred net gains of about $2 million. So what that means is that the actuarial value of assets is currently $2 million lower than the market value of assets because we have $2 million worth of gains that we have not yet recognized in the actuarial value of assets. What that means is that absent any future offsetting market losses, that will help to put downward pressure on the contribution and help to improve the funded status over the next few years as we recognize those gains over time. Any questions on that? All right, moving on to page 3. This is analysis we prepare every year. We look at and I understand that you're looking at your asset allocation. There may be some changes, but as of the valuation date, this reflects your current asset allocation as of the valuation date. And we've graphed that allocation in the top part of this page up here. Each bubble represents an asset class in which the plan is invested. The larger the bubble, the higher the allocation to that particular asset class. Along the left-hand side is the expected returns. So the higher the return, the higher on the graph that is. Along the bottom is the riskiness or the volatility of those returns measured in standard deviation. The further to the right, the higher the riskiness of that particular investment class is. This black dot represents your entire portfolio. Looking to the bottom portion of this page, we look at the expected returns over a long period of time and graph the probability of the portfolio attaining certain returns. And in any given year, short years, you can have a much wider range of outcomes. We saw that on the previous page, the volatility and the outcomes that you can have in any given year. But over time, the returns are expected to tend towards what we call the 50th percentile or the median, and which means that 50% of the time you can expect the fund to outperform that target, and 50% of the time you can expect it to not quite perform that well. Based on Milliman's capital market assumptions, so every investment consultants have their own sets of capital market assumptions. Ours are usually generally in the ballpark of others, but not exact. They won't match BlackRock's exactly, but generally in the ballpark. Our long-term expected rate of return is about 6.8% over a 30-year time horizon. We're looking at a long time horizon, given that this is a long-term obligation. We're currently using 6.9% to value the liability, so we're pretty much right where we need to be. So there's, as of right now, based on the current allocation, there's no recommendation to make any changes to the investment return assumption. Any questions? Okay. Moving on to page 4, we'll look at the funded status of the plan, both as of the valuation date and over the last several years. The accrued liability in the top left-hand part of the page grew from $287 million last year to $293 million this year. Now, we expected it to grow to just under $294 million before any changes to the assumptions, to the mortality update. The actual liability for updating the mortality assumption was $296 million. So there was about a $2 million loss due to demographic experience during the year. Those losses are mainly due to fewer deaths than expected and higher salary increases than expected. Those losses were partially offset due to gains resulting from fewer retirements than we expected, but there was overall a net loss of about $2 million. With the recommended update to the mortality assumption, that lowered the liability by about $2.9 million. So that's how we get to the $293.1 million as of July 1st, 2025. Moving to the bottom portion of this page, we look at the unfunded accrued liability. So despite the the liability losses, I apologize, the unfunded accrued liability decreased. And that was mainly a function of the investment performance that has been recognized over the last several years. We've had 3 strong years of returns, and those are being recognized in the actuarial value of assets. So that's helping to reduce that unfunded liability. Likewise, it's helping to improve the funded ratio. So the funded ratio is up to 84.7%. We expected the funded ratio to be just south of 84% at 83.9%. So the funded ratio is slightly higher than expected from this time last year. So all in all, everything's moving in the right direction with respect to the funded status of the plan. Any questions? Okay, moving on to page 5. This is where we calculate the actuarially determined contribution for the town to make to the plan each year. And you can see that the contribution has actually gone down from $6.1 million last year to $5.4 million this year. We expected the contribution to stay level at around $6 million. So it actually went down. And that's mainly, again, a function of the reduction in the unfunded accrued liability. And the reduction in the normal cost. And the reduction in normal cost is mainly a function of the declining active population. The normal cost represents the value of benefits expected to be earned by your active membership each year. And as that active membership declines, the normal cost is expected to decline with time as well. So that resulted in a decrease in the normal cost this year, as well as a decrease in the past service costs, which is represented by this darker green shade, and that's the amortization of the unfunded accrued liability. So since that shrunk, the past service costs has shrunk as well. That's being paid down over a period of time. We're currently at a 16-year amortization period. So what that means is in 16 years, absent any future gains or losses, we expect the plan to be fully funded within a 16-year period. Any questions on that? All right. Moving on to page 6. These are all the detailed gory numbers for anyone who's interested. I'm not going to go through all this in detail, but I do want to point out a couple things. I have 3 columns of results for 2025 shown here. The baseline reflects still only a 50% phase-in of the mortality. Sorry, not the mortality, the assumptions from the experience study. So it reflects updated census information, it reflects updated asset information, but doesn't finish the phase in of the experience study assumptions. So if we hadn't reflected that, you would have been at $5.6 million for the year. Phasing in the rest of the mortality, the experience study assumptions brought the liability up by about $1 million, and likewise brought the contribution up by about $100,000. But then our recommended change to switch to the Pub 2016 mortality tables, which is the most up-to-date table available today, brings the liability down a bit, and as well as the contribution to $5.4 million. And we're seeing this across the board for all general employee plans, a decrease in liability as a result of this mortality table update. What that means is that the original table had too optimistic of a perspective on future mortality, and in reality, the updated data and the updated analysis has shown that mortality has not been quite as good as we the life expectancy has not been quite as long as we thought. And just so you know, this updated mortality table only reflects experience through the end of 2019, so it's still pre-pandemic experience. And the Society of Actuaries is going to wait a few more years before it reflects anything from that period of time to see where things have normalized to, so to not let that period introduce too much noise into the study. Any questions? All right. Lastly, sorry, was there a question?
No, I'm sorry.
Lastly, I've graphed a 10-year projection of the actuarially determined contributions. This reflects the far right-hand column. So this assumes you adopt the updated mortality table, and this is what, assuming everything comes true and all the assets perform exactly as expected and the liability changes exactly as expected. This is the expectation of how the actuarially determined contribution will evolve over time. You'll see an uptick in the contribution in the first year and a slight decrease in the funded ratio. That's because next year we're going to recognize that final 20% of that loss from fiscal year 22. So that's putting some downward pressure on things. But then after that, we're just recognizing gains, and you'll see that a steady decrease in the contribution and increase in the funded ratio until it kind of levels out the rest of the 10-year period. And that's all I have for the town pension plan. Any questions on that before I move on to the police and fire?
Yeah, I mean, it's not really a question. I always ask this. I guess you do a terrific job for us, and you do this obviously for other entities. Everything you just gave us was objective. Can you be a bit subjective? Do you think we're doing a good job? Are you okay with our discount rate assumption?
Yes, I think you're doing a great job. I think you're making the right decisions. We did the experience study. You've implemented those changes. We're staying up to date on all that and keeping a good check-in. As far as the discount rate assumption, your asset allocation supports what we're using, and you're pretty much in the middle of the pack as far as the rest of the state. I'd say the average discount rate assumption in the state of Connecticut is around 6 3/4. So you're a little higher, but your asset allocation supports that. So, you can't look at it just as a pure apple-to-apple comparison to the rest of the state. You have to look at how you're invested as well, and what you're taking on in your portfolio. I think you're making all the right decisions, and moving pragmatically and so far. Yes.
Okay. Any other questions on this document before we move over to police and fire?
Jen, I just had a quick question. I'm Clay Risher. I'm new to the board, so pardon me if there's some naivete in this question. But why is the pension, not open to new firefighters or you know what I mean? I think you said that earlier.
Yeah. So this is the town pension plan. So this covers The Board of Ed and the general town employees, not the police and fire. That has a separate
Oh,
plan.
okay, gotcha. Sorry.
And so this plan that's part of the ongoing contract negotiations with all the bargaining units. And as part of those negotiations, the plan was bargained to be closed, and those members all go into a 401A plan, a defined contribution plan now.
Gotcha. Sorry about that. I said it was going to be naive, so thank you.
That's fine, and we're trying to put ourselves out of business here.
Well, I have one question. Given that the town employee plan is now closed, does there come a point where a different vehicle for the pension makes more sense? I know some pensions go and they glide path themselves into annuity-based situations where you don't have to invest and you purchase annuities. Private companies do this when they eliminate pension plans. And I'm wondering where is there a tipping point where that makes sense here? As people drop off and you don't, as the population ages that are eligible.
Yeah, so the biggest difference between public pension plans and private pension plans is that private pension plans measure their liabilities on their books on a bond rate basis. So they're using much lower rates to value their liability. They're not using a 6.9% expectation. They're using closer to 4 or 5%, which is more in line with the cost to annuitize. So if you were to purchase an annuity from an insurance company and transfer the liability from the plan to an insurance company, they would charge you a rate that is more in line with what a corporate bond would yield. So there's not a discrepancy in cost there. For this plan to transfer any kind of liability from where it is now, valuing the liability at 6.9% to transferring it, say, at 4.5%, that's a 250 basis point gap there. The liability at 6.9% is just under $300 million. At 4.5%, that might be a $450 million liability. So it's a much bigger cost. So it's not very common in the public sector to do that. Now, given that the plan is closed, over time, you may want to think about how you invest the assets that are used for this plan versus the police and fire plan, because you have a shorter duration on that liability, right? Because it's an older group, and so you may think about bifurcating your assets at some point in time. I think it's too early to thinking about that now. The plan's been closed, but not for that long, and you still have a fairly decent duration on this liability. But that's something that with your investment advisors you could discuss over time as to what makes sense to take risk off the table. But this plan is still only at 85% funded, so you want to get to 100% funded, keep those return seeking assets as part of the picture in the meantime.
It's actually an extremely excellent question, but not necessarily for this particular moment. I mean, it's actually, I read an interesting article. I mean, it's not to get off topic, but in public pensions, there's a huge mismatch, right? Because on one hand, you have guaranteed liabilities, and then we're doing risk-taking assets. That's why on the corporate side, it's much more properly managed, because they have guaranteed liabilities, and then they have a rate that's closer to a guaranteed rate. Some actually use treasury rates, right? That's how it really should be done. But that's a whole different kettle of fish. And as Jen said, if we were to even contemplate something like this, at this point, it would be all it is reflecting the risk that we're taking, by the way. It's not, it's actually numerically telling you the mismatch on the risk, but it's just the way public plans are managed, so.
Right, and if you were to take that risk off the table over time, as this plan becomes more mature and is eventually only retirees, you may want to do that, but that would increase your liability. So you have to do it strategically and systematically.
It's a great question. I'm glad, and you gave a great answer, so we appreciate that. Are there any other questions before we move on to the police and fire? With Jen. Okay, go ahead. Why don't you move on to the police and fire?
All right.
And just tell us the name of that document again.
It is similar name. It says FFP on it.
Okay. FFP
2025 pension valuation.
Okay, I think I got it. Is that,
Another
it?
10-page document.
Another 10-pager, right.
Yep.
FFP 2025 pension valuation.
That's right.
Okay.
Okay, so with the police, this is the police and fire pension plan. It's a somewhat similar story thematically. Again, another good return, a slight improvement in the funded ratio. Again, we're phasing in the second year of those assumption changes, and also again making a recommendation to the mortality table as well. So moving on to page 1, the demographics in the top left-hand corner of this page. You'll see there's only 3 terminated members. So the terminated members are not nearly as prevalent in a police and fire plan, because many police and fire employees go straight from active membership to retirement. So there's only 3 that are due a vested benefit at some point in the future. Moving on to the next group, there are 241 members in PACE status. So those are the people collecting a benefit as of the valuation date. And then your active memberships at 210. And you can see what different from the town plan, the police and fire plan, that active membership has been fairly steady. It's actually slightly crept up in the last couple of years, but it's been fairly constant. And that's usually what we expect. You'll see in the bottom left-hand portion of this page that the distribution is much more widespread because of the open nature of the plan. You have a significant amount of early younger folks early on in their career, but it also have people in mid-career as well as late career. So it's fairly widespread over time. The breakdown between the police and fire as of the valuation date is 112 active police members and 98 active fire members. That ratio is pretty consistent with last year as well. Any questions on the membership? All right, so moving on to page 2, this looks very similar to the town plan. We expected investment income of about $15 million last year, and the actual investment income was just under $20 million for the year. So a $4.5 million investment gain above and beyond what we expected. Again, we're smoothing assets over a 5-year period, so we're recognizing any market gains and losses 20% each year. So again, this strong year in fiscal year 21 is now fully recognized. We have 1 more year left of this tough year, and then 3 strong years that will be continued to be recognized. As a result, as of the valuation date, the actuarial value of assets is $1.6 million greater than the market value. Again, that will help to put upward pressure on the funding ratio and downward pressure on the town's contribution over the next several years, absent any offsetting market losses. I'm going to skip over page 3 because this is a carbon copy identical to the town plan, because the 2 plans are invested in one large pot, and we just allocate the assets for purposes of evaluation. So same story here as with the town plan. Moving on to page 4, the accrued liability went from $285.1 million last year to just under $298 million this year. We expected, before the mortality assumption update, we expected the liability to grow to about $297 million. Again, before the mortality update, the liability was about $298 million. So this is a $1.5 million loss as a result of demographic experience during the year. And that was primarily due to higher salary increases than expected. And I'm going to say that with a caveat, because at the time we've done the valuation, the police and fire contracts had not been finalized. I think they might still not be finalized. So salaries for July 1st, 2025 have not been fully set. In talking with Tom, in his guidance, we used an assumption of 3% to the wage growth for the year, based on what is expected to be implemented. Doesn't mean it's what it's going to be implemented. So to the extent that it varies from that, that variance will be reflected in next year's valuation. But that was the primary driver of the liability loss for the police and fire plan. Again, with the recommended update to the mortality assumption, that brought the liability down by about $600,000. So not as big of an impact for the police and fire plan as with the town plan. And that is consistent with what we've seen across the state and other plans. As you know, the public plan mortality tables have different flavors. Those one for general employees and another one for public safety type employees, and the updated study didn't show nearly as much movement on the public safety side as it did for the general employee side. So not as big of an impact with that mortality assumption update. But at the end of the day, the liability is just under $298 million as of July 1st, 2025. The unfunded liability did grow a bit from 61.7 to 63.4. It's pretty much where we expected it to be. So the liability losses on the police and fire plan were completely offset by the asset gains, essentially. So the unfunded liability pretty much grew as we expected. Likewise, the funded ratio went up just a tick from 78.4% last year to 78.7%, and that's exactly where we expected it to be. So the police and fire plan is pretty much on track to where we thought it would be a year ago today. Moving on to the contribution calculation, you'll see that the contribution increased from just under $9 million last year to $9.8 million this year. We actually expected the contribution to increase to $9.7 million. So this increase is not surprising to us based on our projections from last year. Slightly higher than expected, and that's mainly a function of those liability losses I just previously talked about. Looking at the components of the contribution up top, the normal cost has increased a bit, and that's because the salary losses, the higher salaries than expected means higher future projected benefits than expected, and therefore that the value of the benefits being earned in the upcoming year is higher than we thought they would be. And likewise, the past service cost has gone up from just under $5.2 million last year to $5.5 million this year. Moving on to page 6, we have the same scenarios that we had for the town pension plan. The baseline shows the updated assets, the impact of the updated assets in the census information, as well as not phasing in the remaining experience study assumptions. That would have put the contribution at just about $9.3 million this year. The fully phasing in the experience study increased the liability by about $3 million, and likewise the contribution by about $600,000. And that was pulled back a little bit with the update to mortality assumption, bringing down the liability about $600,000 and the contribution by about $60,000. So that's how we get to the $9.8 million for this year. And then moving on to page 7, our 10-year projection, a similar kind of trend as you saw with the town plan, a slight dip in the funded ratio, a slight tick up in the contribution as we recognize that last year of the phase-in of the fiscal year 22 asset losses, and then some slight decreases as we recognize the remaining gains, and then a steady incline as the plan continues to grow over time. The police and fire, you see the contributions growing over time because the plan is open still and continuing to bring in new members and accrue, and it's getting larger, whereas the town plan is actually shrinking. So that's why you see that difference there. Any questions on that?
Jen, Eric Caliper, I have a question.
Sure.
Between the two plans, there's like a 14 basis point difference in investment returns.
Mm-hmm.
And then
Yeah.
significant difference between BlackRock's numbers as of June 30th. Any reason for the delta?
The returns, it's just our returns assume a mid-year cash flow timing, and so there could be slight. BlackRock's might reflect actual timing of cash flows. The difference between the two plans, I think, is primarily probably a large chunk of the assets is in one single trust, and then each plan has its own small little kind of side account for doing the cash flows, paying expenses, paying benefits. So there's some slight differences there that might be causing that slight discrepancy.
Yeah, because I'm looking at like an average of 9 between the two pension plans.
Yeah.
And then BlackRock's June 30th numbers show 11.7%.
Okay.
So I just,
It could be a timing thing of when contributions or other cash flows came in their measurement versus our mid-year assumption.
Yeah, contributions land July, so they're made basically
Yeah.
at the beginning of the year. I
Yeah.
was
So
also
that's,
noticing that that the market value of assets is slightly different. That the market value of assets in the combined plans is like 5 or 6 million lower than what we account for in our June 30th report. We have about 492.5 million in the pension as of June 30th, and that could just be like I don't. Not 100% sure. I don't generally see Wilmington's trust statements, but
yeah. And we use the assets that are reported to us for the fiscal year end audit for the ACFR. And so, I mean, this comes from Tom and his group, and there could be potentially some adjustments that are reflected there that are not necessarily in the Wilmington trust statements.
all right, thank you very much.
Any other questions on the police and fire pension before I move on to OPEB? Okay.
Okay, thank you. OPEB it is.
All right, we'll do the town OPEB first, and these will be quick because there's not too much to talk about. Let me just share this one. So, as I mentioned, so this file is called FFT OPEB
Yep.
2627 ADC. So move on to.
Starts with a letter.
It starts with a letter. We're going to skip the letter. That's just the page. So first page is just the summary of fund transactions during the year. This is what's provided to us by Tom and his group for purposes of the audit. Good return, strong return during the year, 19%. So that's well above beyond the expectation. Moving on to the actuarial value of asset calculation, we just started smoothing assets a few years ago. So you'll see we're only that bad year of fiscal year 22 is not reflected in. Oh, am I not sharing? Sorry about that. The bad year of 2022 is not being reflected in the actuarial value of asset calculation because we didn't start reflecting it, start smoothing assets till the following year. So right now the actuarial value of asset calculation is purely just doing deferred gains. So you'll see that the actual value of assets is $44.8 million relative to the actual market value of $51 million. So a big disconnect there. That's because we have $6 million worth of investment gains that will be recognized over the next several years. But moving that into the calculation of the contribution, again, the liability is the liability that we projected based off of last year's valuation. So we assume that the liability grows exactly as is expected. We'll recalibrate that measurement when we do the full valuation next year. So the accrued liability increased from $55 million last year to $58.5 million this year. But a strong return, therefore the unfunded accrued liability has gone down. And the funded ratio is improved to just under 77%. We amortize that over 6 years and get an amortization payment of just under $1.2 million. The next portion of the calculation is the normal cost. And that, again, that's the value of benefits expected to be earned by your active members over the course of the next year. We adjust that for any administrative expenses we expect you to pay out of the trust. And come up with a net normal cost of $1.4 million. And then we adjust for interest to the timing of the contribution and gives us a contribution of $2.8 million, slightly lower than what we were expecting the contribution to be. And that's primarily because the assets performed better than expected during the year. This liability number does reflect the second year of phasing in the assumptions. So we did reflect that in our expectation. It does not reflect the update to the mortality assumption yet, though, because that will reflect that with next year's valuation when we do the full valuation. Any questions on that? Okay, let me just pull up the other one, which is the FFP, Police and Fire, OPEB. right. So the one thing to note here is that the police and fire plan had a much different return. You'll see it only returned about 5.5% during the year, based on the numbers we were provided. Not sure the cause of that. Maybe BlackRock can shed some more light on that. But I was under the impression that both plans were invested similarly, so I was a little bit surprised by this result. But these are the cash flows that were provided to us for
Something-
purposes of the year-end audit.
Kosher.
Yeah, so I caught that too, Jen.
Yeah,
And so you have a
5.6.
market return of about 5.7 for the police fire and 18 for the town.
yeah.
And BlackRock reported 13.8, so something's awry there.
Yeah, so I'm concerned with what we provided is maybe not accurate. What we were provided to us was maybe not accurate. Something to note, I actually got a call from the auditors just early this afternoon, and they found something on the OPEB that they want to discuss with me. I don't know what that is, so it's possible that these numbers might change as a result of that. I have a call with them tomorrow, and
Maybe they're calling you with a briefcase of cash that
so the cash flows as far as the benefit payments and the member contributions, town contributions, all looked reasonable, but the investment income component looked off. So I have a feeling something's missing there. And
Can we, Calvin, can we have an action plan to have Jen follow up with Tom Harris to make sure this ties out?
Sure.
Yeah, just, I mean, it's obviously some sort of honest mistake, but we don't want to memorialize it.
yes, certainly. So that obviously would flow through the calculation, and it does result in a contribution. I won't go through all the details of about 6.5 million, slightly higher than we expected, because again, we expected it was actually lower than we expected, because while the market return was on paper only 5.7% here, the actuarial value of assets still returned greater than 6.9% assumed. So our actuarial value of assets is still higher than we expected it to be. Therefore, the contribution is slightly lower than we expected it to be. But all that being said, if the market value of asset figure is not correct, if this is actually a higher number, or if this number is correct, but the ins and outs are not right, that could change the end contribution result. So I will, like I said, I'll be speaking with the town's auditors tomorrow about the OPEB plans, and I will follow up with Tom and his group to make sure that there's not something missing here, and let the group know.
Okay. Let's make sure we get a report back from Tom, either between meetings or certainly at the next meeting.
Yeah.
Okay.
Put that on old business.
Does anybody else have anything in terms of how we resolve this? I mean, I just want to make sure it's
Well, I just think that,
appropriate.
and I've been a very big proponent of this. That's why Millman comes before the board first.
Right.
Before the numbers make it in the budget book.
Yep. This is a substantial deviation that doesn't make much sense. Are BlackRock guys on the call here, audibly?
Yeah, Josh.
Yep.
Have you been listening to and have any thoughts on what we're talking about here?
No, listening in, but this all sounds good. I mean, obviously, some of the maybe audit questions that might get updated, but this all sounds pretty reasonable. And the phase-in, I remember that from last year, the discussion about the phase-in of the assumptions, which was the decision made last year. So that makes sense.
Okay, you know what? We have an action plan. We're going to have Jen and Tom touch base and get back to us no later than the next meeting. Okay? Okay. Good. Jen, is there anything left?
No, just from I can't recall if from a governance perspective, if the board needs to vote on the recommended mortality update or not.
Yeah, absolutely. Is there, is there anything else before why don't we finish you up and then we can take that vote? Looks like you're done.
Yep.
And you're relieved. Are there any other questions for Jen before we take a vote to accept the revised tables? Okay, anybody want to make a motion?
I'll make a motion.
Okay, the motion is to accept the new, I'm losing my mind, 2016 table, was it? Okay.
16 retirement tables.
Yeah. Any comments or questions on that issue? Okay, all in favor? Aye.
Aye.
Opposed?
road.
Thank you. Any opposed? Okay. Approved. Accepted. Okay, I think, other than this issue with the discrepancy in the returns, I think everything else was on target and appreciated.
All right, thank you.
Thank you, Jen. You have a good evening.
You too. Take care.
Okay,
Thank you.
okay. So we just want to make sure that our CFO and these guys figure out how to tie that out. Just not kosher in the investment world. Okey doke. I believe BlackRock is up next. They are going to be brief on this snowy evening. Performance return discussion and an endless SAA discussion.
Yes, and I definitely don't want to keep you all too late with, I don't know how much more snow you're getting. I look out my window and it touched 80 today, so I'll leave it there for you all.
He does that like every meeting.
It got so hot he had to trim the beard.
Yeah, right.
It's so hot he trimmed the
That's
beard.
exactly right.
Also a
That's exactly
discrepancy
right.
in numbers.
So we'll just jump into the January performance. I know at the last JRIB, we were basically almost at the close of January, so not much changed in the last couple of days post that commentary. In the BlackRock presentation, I'm on page 4, which shows the pension assets at $536 million as of January 31st. That 1.9-ish% return is about in line with what we discussed at the last meeting, with a 9.65 for the fiscal year to date. So again, far exceeding the actuarial return thus far this fiscal year, which, as Jen just presented to everyone, that as you outperform that actuarial number, that prior service cost or unfunded liability shrinks a bit quicker than you expected, and that should be positive down the line for your contributions per se. I won't spend too much time on January. It's hard to remember that back in January we saw a bunch of geopolitical risk. There was talk about Greenland and the capturing of the Venezuelan President Maduro. I think things have accelerated macro-wise throughout February. So before we jump through the rest of the presentation, I'll just give you 2 or 3 brief minutes on kind of what's been going on in February and an update to the NAVs performances of both plans through February. We've seen much the same as we saw at the beginning of last year. Diversification has helped. Non-U.S. assets have outperformed U.S. assets. February, we started to see, much like last year with the launch of DeepSeek and the Chinese, LLMs that, led to some of the questionings of CapEx here. February's had a very similar, though kind of more domestic hit here, right, with Anthropic releasing their Claude AI tools for not just coding, but beyond into the professional space. And we've seen, kind of, as they say, the SaaS apocalypse, or all of these services businesses that have taken a hit, and all of the software businesses that have taken a hit. Net is the NASDAQ is down about 2% year to date. The S&P, month to date, the S&P down 1 until the last day or two. On a year to date basis, the NASDAQ is down 1. The S&P is at about plus 0.8 or about plus 0.75. Whereas if you look elsewhere, EM is up 13% year to date. Japan is up 11.5% year to date. Europe is up 6% year to date. And on the month basis, those are all also more strongly positive, 4% for EM, 6% for Japan, and 3% for Europe. So again, having this diversified, globally allocated equity portfolio has benefited both the pension and the OPEB funds. On the rate side, certainly the stronger economic data that we saw coming through January into February, decent job numbers that came out, the unemployment rate kind of staying where it is, inflation moderating, GDP growth, while it took a hit, was a lot attributed to the fact that the government was shut down for half of the last quarter. And, if you offset some of that, there's still pretty decently strong growth. So what we saw in January and really into February was this push out of the expectation of Fed cutting. There's still an expectation the Fed is going to cut more, but instead of it being kind of a Q1 or very early Q2, kind of the right now estimate is the June meeting would be the first 25 basis point cut of 2026. Certainly, Fed governors are expected to change over the next couple of months, but we saw rates move up slightly in February. And so your fixed income returns have been a bit lower, just given that rates have moved up. So, you can even see on this page here, the January performance fixed income return of about 0.25%, which, only annualizes out to about 3%. Which is below where current yields are. So that was yields pushing up a little bit. We did see with this software sell-off a bit of a flight to safety in terms of long rates have come down about 10 basis points over the last week and a half or so, or 2 weeks. They're down 20 basis points for the month. So that's beneficial for your fixed income returns. But, as we know, rates, especially at the middle to long end, we're kind of expecting them to stay a bit elevated. Government deficits are still astronomically high. There's nothing being done to kind of go after those. Inflation, while it's moderating, is expected to land at about 3. And so much of the rate movement that we expect will be at the shorter end, coming down a little bit, with the longer end staying flat to slightly elevated. So there's nice income per se, but the real thrust of your growth in the economic return, as we've discussed in the SAA, is coming from the riskier assets, the equities and the private market assets that you have in the portfolio. So with all that being said, the pension fund as of February 24th, stood at about 542.1 million in assets. So that's another increase of a little bit under 6 million for the month. That's a return of a little bit over 1% for a fiscal year to date return through kind of yesterday of about 10.8. On the OPEB side, down at the bottom, at the end of January, you were at 114.3 million in assets. As of yesterday, or close yesterday, you were at 115.7 million. So another $1.5 or $1.4 million increase on the month. And that's a return of about 1.3%. Fiscal year to date, you're rounding out to 13% return on the OPEB. So again, through kind of close of February, with about 4 months left in your fiscal year, both pension and OPEB performing again, low double digits, strongly above the actuarial expected return, that has been set, and riding on the backs of the continued equity rally and the strengths of the equity markets. That we think there will be added volatility here, as there's certainly been some surprising reactions to think pieces or small market commentaries that have driven whole sectors up or down that are recovering or in the process of recovering, but that's not going to expect to happen overnight. But this is not, at least on the horizon, kind of a long expected drawdown broadly across markets. I mean, you look at in the U.S. earnings season is basically done, and we saw about 14% year-over-year earnings growth, which is higher than what was expected, and it's broadening out beyond the AI capex hyperscalers and big mega tech. You're starting to see small cap rally. You're starting to see, I think 10 of the 11 sectors saw double-digit growth in earnings, and so this is all just kind of supporting a broader equity, continued broader equity rally, even if we're not going to see 20% returns. Still seeing healthy returns from the equity side. That should benefit both the pension and the OPEB funds. So pause there for any questions. This is a pretty abridged report here, just given most of the portfolio is passive. And so we break out some of the updated returns through the end of January, especially on page 7, where you can see kind of each of the sub buckets of the portfolio of the pension. And then similarly, I think it's page 9 or 10 for the OPEB fund.
Rising tide lifts all boats. It's been a good period. I will just put an underline on what you did say, which is I'm guilty. Different sectors contribute at different times. International equities were, a quote unquote tragedy forever, and now all of a sudden they're a bit of an engine for us. So, no one knows where the markets are going in the short or medium term, and not even the long term, but we do know that a diversified portfolio is our best bet, and it's showing right now, in my opinion.
Yeah, I mean, it's super interesting. The value factor in the U.S. outperforming the growth factor by 10% on the year already. It's you're seeing just the market move towards what has been undervalued, and I think that there's just this underlying sentiment of, maybe some of the AI valuations got a little too inflated, a little too over their skis, but not to pull those back per se, but to kind of shift your dollars elsewhere in the market. This is not we have a negative view because these mega caps tech stocks have gotten overvalued. It's the rest of the economy was doing decently. There's room for growth in a bunch of other sectors, and you're seeing some rotation right now going on. But again, having that diversified allocation, you're not just owning the NASDAQ or you're not just owning the S&P 500. You get to benefit from that rotation without actively trying to shift your dollars.
Hey, Josh, quick question. I saw an article that quoted BlackRock research piece from last week. It said software makes up a sizable portion of many private equity funds, so AI disruption could be existential for some portfolio companies. I'm sure BlackRock puts out a lot of research. Is that a firm view, and does that inform anything relevant to our SAA and portfolio decisions? Have you looked at how I think in our case, the HarborVest and maybe Lexington portfolios are exposed there?
Offhand, I don't have the current PE allocation amongst software. I think the bigger risk, and where maybe the think piece was more focused on, was on the private credit side, where software tends to make up about 20 or 25% of a lot of those kind of middle market direct lending loans. And I think there's a lot of dispersion within that subsector, right? There's certainly, across the board and across industries and sectors going to be winners and losers and companies that don't make it. I think the highlight of the last couple of weeks was just how disruptive AI could potentially be to these businesses. My personal view is
I think it spoke about that. Yeah.
Yeah. And that's certainly, I think, a risk within the private credit industry of who are you lending to? What are the qualities of these companies, and kind of the assumptions you may have made when you made a loan 2-3 years ago, kind of before the AI ramp up. And, there is some of this reaction and, in my opinion, a bit overreaction to some AI tools coming out, and all of a sudden stocks are worth zero is not, I think, a reasonable expectation, but you do see that kind of ported across then all of these sub portfolio companies within some of these private markets, because you don't necessarily know who they are outside of the GP and the investment fund knowing and having done their diligence. But there's a bit of that is overblown, and a lot of the underwriting within private credit, a lot of the loans don't always stay out to maturity; they refinance, and so there's ways for them to re-underwrite some of those loans. Again, I think the risk is
talking about like PIK financing.
Yeah, and I think a little bit of it is a bit more overblown. There's certainly risks, and there's certainly companies that are not worth what they're certainly valued. And if some of these AI tools do actually get adopted broadly, you'll see some of these software companies struggle. And that is probably something the private credit industry is going to have to think about, how much sector level diversification. It just so happened that kind of post-COVID through now, a big portion of these loans did go out to software companies that were kind of building up post-COVID, think remote work and all those kinds of services. So.
Yeah, and it definitely, obviously, that's been a huge thing this week with private credit. The reason I thought it was relevant to our conversation is because what I read was private equity. So I just, to kind of narrow the lens, I guess maybe it would be helpful just over email or something if you were able to look at maybe just software exposures and the funds that we're already in.
Yeah.
It should be pretty readily available, I would guess.
Yeah, and I think we have the 930 statements available from the PE managers. We're still waiting on the 1231 statements and holdings, but we could pull that together.
Probably useful for us.
If there's any other questions on the portfolio performance? We can hop over to continued SAA discussion. I know last month we put a pause on a vote. Ken, I'm happy to open up for discussion if there's any other thoughts or people want a kind of reminder or an overview of some of the options that are still on the table.
Yeah, I don't, and I wasn't here at the last meeting, but, and I'm being very careful how I choose my words because I don't want to put my words in anybody's mouth. The sense I'm getting is that if what's not broke, don't fix. Again, please speak up if anybody here disagrees. I mean, you guys did a good job. I think you honorably showed us that, it's not like something was put in front of us that was jumping off the page, obvious that we should be making changes. We have our commitments to our providers. It's funny. There's been some questions about the real estate fund, and yet, 6 months ago, I was moaning about international equity, right? So, I don't know if we're going to be in real estate. Are these guys any better or worse than anybody else? I tend to be a cynic about active management fundamentally. So either it's in a sector or not. To me, in other words, I'm not arguing about whether these guys are good or not. If we're going to have 5% to private real estate, nobody's convinced me that these guys are worse than other providers. That's all I'm saying. Just because the performance hasn't been so good, I think reflects that the sector hasn't been so good. But again, I'm
I'd
more than happy.
I'd agree with you on that part, that the performance is much more reflective of the industry itself. They're a little bit more kind of their core, itching for core plus in that real estate land. Mm-hmm. So they tend to, the income generation in the fund tends to align with other providers and kind of broad indexes. They've had a bit better in terms of the appreciation, whether that's from actual property selection or where they are versus broader indexes having a little bit less office, starting to, adopt some of the more newer real estate edges. It's not huge outperformance, but they are doing decently fine. And I think the question is much more around, do you want real estate in your portfolio? And I think we're at the point now where valuations have taken such a hit that it's an opportune time to be adding money. Most of these managers are starting to see inflows rather than outflows. Mm-hmm. At the last call, we talked about that principle, based on their most recent statement and communication, has indicated that they've met all exits for the last year. They haven't gated. So when they were in, now it's about 18 months ago, that they had, pretty big queue of people looking for their investors, looking for their money back. And they were able to meet all those obligations without selling properties, without hurting the fund. And they've turned around they have a $200 or $300 million inbound queue right now that they're looking to deploy. So, there's glimmers of hope. In terms of real estate, BlackRock has our views of, U.S. versus Europe. Europe's stabilized a bit earlier, so they're probably 6 months ahead. But you're a long-term investor. We're not trying to tactically allocate around core real estate, for example. There is opportunities, we like value add, where you're looking at even more hit valuation real estate sectors to be able to bring in a bit better improvements and generate a bit higher return, kind of targets, maybe about 300 or 400 basis points higher return than a core real estate fund. But, we wouldn't advocate necessarily that you all need to make a switch. I will say that the OPEB is a bit underfunded on the real estate side. They have a 10% target. They're at about 6.5. But again, a lot of that is just valuation. Real estate didn't recover over the last couple of years, whereas the equity heavy part of the portfolio really rallied. And so that's why you're seeing that drawdown. So to make a new commitment or find a different manager or add more to real estate maybe doesn't necessarily make that much sense right now. And, you have wide enough bands in the IPS to allow that drift.
Does anybody else have comments, either specific or general? I do think one thing we should do is, I don't think we want to just have every meeting continue SAA discussion, so to speak. It's some point, we should be taking it up on a periodic basis, but not every meeting, obviously. So I think we've had enough chance to bat it around.
Hey, Ken, could I interject an observation for the road?
Please.
I wonder if we're looking at this backwards. I'm wondering if we should be looking harder at the IPS and making sure that as a board and individually we're comfortable with what's in the current IPS, and if not, update the IPS, and then think, okay, based on what we all agree we need to be thinking about going forward as an investment board, does the current SAA comport with what we've all agreed is important? So, for example, I'll call out the discussion that seems to recur every few meetings about the Madoff this investment. I admit I still don't quite understand what happened, but it sounds like, Eric, you have a handle on it, but maybe the board needs to have a handle on it, because that to me is the elephant in the room. If hypothetically something bad happens, a drawdown happens, and everybody, a future board, to be clear, votes to disinvest, I think that could be a very bad outcome. So I just want to put out there that kind of thing. All the other one was implicit liquidity in the portfolio. We've talked about that as well. Maybe things like that, the psychology of the board versus a projected maximum drawdown being one, and two, desired liquidity relative to obligations. Those two things should be looked at in the IPS, and then maybe we revisit the SAA maybe next year and say, okay, again, to repeat myself, does it comport with the new IPS? I'll just stop there and see if anybody wants to correct or amplify.
I think it's definitely worth, everyone reviewing the IPS again, and maybe we should make that a March or April agenda item. I will add that, the current SAA you're in was decided back in 2021, so it is codified in the current IPS, which was updated in September. But certainly from, their liquidity constraints, we did have our risk workshop back in August where we talked about return objectives, risk tolerances, liquidity risks. We can certainly add some of that or make sure that aligns with the IPS, or make edits to the IPS to align with that. And then we also have, I know we discussed last time, the kind of SAA review memo that, we're happy to share after this meeting, which, again, can be ported, or some of the observations from that can be added or edited into the IPS as well.
I have no problem with any of that. And Tom suggests, the IPS is a big picture document, obviously. And the SAA is a more precision, I guess, if you want to look at it that way. would everybody like to have a review of the IPS at one of the next meetings, just to make sure everybody's on. We have had a lot of turnover on the board, a lot of new members. It probably wouldn't be a bad idea to, schedule a half hour at a meeting, either, one of the next few meetings, and make sure everybody is on board and comfortable with our, our vision, if you want to call it that.
Yeah, for what it's worth, I think it's more than a half-hour discussion, but Ken, I think that's a
I'm always
valid proposal.
ambitious. I'm ambitious, Tom. Ambitious.
Very ambitious. Very ambitious.
Okay. Okay. Why don't we? I don't know if that's a voting on. Why don't we, Josh? Why don't we plan on that? I'll leave it to you to slot it in over the next, couple of meetings at the latest. Let's not let it go too far. You can coordinate with Calvin on that, which meeting you want to put it on.
You read it, Josh.
I don't think we hear him.
Sorry, thought I was unmuted there. Yes, Calvin will be in touch on this in the next week or so.
Hey, Josh, could I have a question directly for Josh. Have you seen other boards deal with things like the psychology of future boards and linking liquidity, implied liquidity in the portfolio to expected liquidity needs going forward?
So
explicitly in an IPS?
Generally, what we've seen is there be some type of liquidity tolerance or liquidity risk in an IPS. So there can be clarifications of how liquid funds, it could be that granular of we will not invest in funds that are not daily liquid or not quarterly liquid. But usually it's done in context of, making sure that you have liquidity to meet, and it's sort of how we framed the risk workshop, having enough liquidity to meet X amount of benefit payments. And then it's up to kind of the board to try and determine what is that drawdown. We kind of showed you how much of a drawdown in just the liquid portfolio that you have would match a 3-year benefit payment amount. I'm kind of trying to set the liquidity parameters around that, how much illiquid, if you will, kind of private equity where you're just not going to get your money back without going to the secondaries market or something like that, and kind of trying to set then caps to how much illiquid assets that you have, kind of shoehorn that way. And like I said, there is, some boards and committees have the view of, I just don't want any illiquidity, and then they'll voice that in their IPS.
Yeah, and further on that issue, and this is probably a really micro issue, but in terms of volume of dollars, it's huge, which is the extended discussion we have of ETFs versus CTFs. I mean, in terms of dollars committed, that was a huge discussion. So, I mean, that's liquidity that maybe people on the board felt differently about, as I recall the discussion. And then there are new people on the board who aren't probably even aware that this was ever a big issue. So as far as liquidity goes, CTFs versus ETFs, maybe, again, at the risk of getting into something that's very technical, warrants a little bit of discussion on the liquidity front. What do you think about that?
Vehicle type, sometimes is discussed. I mean, the underlying investments are all index funds. I think that's, part of the point that we, maintained during that whole discussion. These are all index funds in publicly traded markets. But, that may be something that you want to add to the IPS or this SAA memo that we've written that will provide you is, why were decisions made, and the rationale for making these splits. Specifically, why is there a 75-25 split of the CTF ETF? Kind of put that documented somewhere, whether that's the IPS or kind of a living, breathing memo document that's not an IPS, but just kind of a summary of what the board has decided over the last, year or two. I think that's really up to you all and how you want to hold it, but that's something.
I think that would be some sort of addendum or codicil rather than in the IPS itself, but no problem.
And Tom, Eric Caliper here, just again to go back to those dark days, that's when we had private money managers. So you had 30, 45-day redemptions. So that was the concern of the board at the time was, being able to put an order in to sell equities to make pension payments and knowing you wouldn't get your cash in 45 days. The current investment vehicles we're in, I mean, we could liquidate an ETF in a day and a half, Josh, right? If we had to.
Yeah, I mean, the ETF trades and, it settles the next day. So
I think
you really needed to.
Yeah, it's totally different investment vehicle, totally different, lubrication and the gears. So.
Well, I don't think we need to revisit the entire topic. We specifically came up with this blend and took a quick look at any foreseeable liquidity requirements we might have. And we're very comfortable that with the percentage of ETF, as Eric's saying. But I do think what Tom is bringing up, though, is a separate, whenever you have a lot of new board members, it doesn't hurt to have a periodic review of some of the structural features of our portfolio.
Yeah, I think let me just amplify that, Ken. I totally agree. I think if Eric weren't on the board right now, we'd all be struggling to understand what happened during the Madoff period. And Eric, you'll be probably bashful to hear this, but thank God for Eric Caliper.
Well, I was around then too. We lost a dump load of money.
Okay, thank God. Thank God for Ken.
You didn't lose. You never had it in first place.
Well, okay, that's actually not true, but okay.
You never had it in the first place.
We lost the money.
In that period, didn't you recover your?
We recovered some of it.
Well, we also
pennies on the dollar. We got a lot.
No.
It was dark. It was a dark.
We had the world's greatest lawyer in hindsight.
Yes, we did.
From what I read, we recovered the principal, but we forewent, if that's the right verb, a lot of S&P appreciation in the meantime.
Yeah, sure did. Yeah. Large opportunity cost.
Yes. A forgettable experience. No, actually, I shouldn't say forgettable. A learning experience, but better in the rearview mirror.
Everybody gets invited to movie night, Eric. Don't worry.
Oh, you heard that?
I may be in Canada, but I can still hear you.
Yeah, I was jealous about that too. Okay.
Everybody's invited. Ken, even you are invited.
Thank you, Tom. I do appreciate it. If you want to remain vice chair, let's see.
You could
Anything else on
have
this
it back
topic?
if you want it.
Yeah. Okay. So I'm hearing no tremendous urge to deviate from our current portfolio allocation construction. Last chance.
I have not been swayed to move.
Nor have I.
Nothing's out there.
Yeah, and not that any of the alternatives that were shown to us were bad or good or in between. It just seems like we've got a pretty good thing going, and maybe sometime in the future something will happen that'll cause us to want to make some adjustments. A lot of this is autopilot. We've made commitments in the alternative space where we're still getting capital calls, et cetera. There's not much we can do, or we should do, I should say.
My only concern is, how the size of emerging market debt has increased considerably over the last decade. You know what I mean? Like there's just almost as much as emerging market debt as there is U.S. debt out there.
You're talking about in the world?
Yeah.
Oh, okay.
So, I mean, I just don't know enough about the bond space to speak on it, but it just seems like it's a huge chunk right now, good or bad.
A missed piece of diversification.
Maybe or just the opposite. There's too much risk out there in it. I don't know.
Well, there's a lot of bonds. Josh, did you hear Eric's question? Yeah.
Yeah, I mean, within the fixed income space, EMD has been one of the better performing assets over the last 12 or 18 months, both hard and local currency. Hard currency would be debt issued by emerging governments in US dollars, whereas local currency obviously done in their own local currency space. Some of that is a play on US dollar weakness. So we saw local currency, the fact that you have that exposure. I will point out that the non-US investment grade bonds that you have, the non-US ag, is a good chunk of, European government debt is in there, but it's all hedged back to the USD. So a weakening US dollar was a bit of a headwind for the non-US fixed income returns last year. But that's what we're seeing a bit more kind of on the tactical side from a fixed income perspective of how tight corporate spreads are. You're seeing a bit more attractive all-in yield going through the emerging market debt space. A lot of the central banks there have their inflation under control, coming out of COVID. Some of the emerging markets were the first to actually get a better control. They raised rates really rapidly, and we've seen those rates start to decline. And then it's, what's underlying all of these assets, in the hard currency space, there's a number of Middle East country debt. So you get a bit of that, oil backing that debt. And then in the local currency space, it's kind of globally. And we're just seeing an emergence. You see it in the equity side. So strong, having been undervalued for a very long time. So there's a bit of a valuation play going on as well, that all of this debt is not, to the point of Eric asking if it's risky, I think the market is interpreting it's a little bit less risky than had been priced in previously, as you're seeing some of the macro data from a lot of these emerging countries looking a bit better and a bit more robust than I think you may have expected kind of coming out of COVID. So it's just, in terms, the way that we view adding it is not a huge allocation that you make, but it's a diversifying allocation, because most of the fixed income you tend to invest in is all developed market, has some spread assets, corporate bond allocations in there. And, these are still sovereign bonds, and the USD denominated bonds, right, are still kind of issued relative to the US Treasury curve. And so there's some attractiveness to how US rates might play versus how rates will play elsewhere. And then you look at the US has almost $40 trillion fiscal deficit, and some of these other countries are in a bit better fiscal position, surprisingly, than some of the developed market countries. And so it's that also play, even across Europe, the UK, the fiscal situations are, not as attractive without some austerity on the horizon, as we've seen now in some of the emerging market space. But I'll circle back to Ken's original point here, right? I mean, I think we entered the discussion with the current SAA works. I think you heard it from your actuary as well, that it supports the required return that you need. We've certainly seen over the last 3 years, you far exceed that expected return. This is obviously a long-term expectation that you're looking at, but you do have a decent balance between your risky and riskier assets, your equities, your private equities, and then the diversifiers in your portfolio, all of the fixed income, the real estate, that should provide you, hitting that expected return. And I think, again, remembering back to that August risk workshop, the annual volatility is obviously going to exist. You even saw it in the Milliman exhibit, right, where like the 5-year numbers are much wider than as you get further out to 30 years. And the bigger risk that I think the JRIB all kind of coalesced around was undershooting the 6.9 over a 10 or 15-year horizon is a worse outcome than 1 year having a negative return and then seeing it bounce back the next year, just because the longer you underperform, you embed bigger and bigger shortfalls that need to be amortized and that need to be made up through contributions. And so the focus really is, can we hit that return? Can we hit it pretty consistently, and avoid really long-term underperformance of that level? And, based on kind of where we are today, capital market assumptions, both Milliman's and BlackRock's kind of support that the current portfolio hits your return objectives. And so I'll just, I think I'm beating a dead horse and being quite repetitive, but I think I'm, there's certainly opportunities to tweak the portfolio, but it does seem that the current portfolio is, does meet the objectives that the JRIB has. And so, there isn't a pressing need to change the portfolio.
Yeah. Yeah. See, one person's raring to go over here. Okay. Let's see. I guess we have old business and new business. I'll put those together and ask if there's any of either.
No business.
Nope. No business. Would anybody like to make a very exciting motion?
I will motion to adjourn.
Oh, I was looking over here, but okay. Second over here. Christine, all in favor?
Aye.
Okay. Thank you, everybody who got on the call remotely. Tom on the road, Joe, everybody, BlackRock guys, thank you.